very much for stopping by and watching our life goal investment video on why not to own 100% stocks. Let's start out with a tricky little question over here. Let's say you buy an investment with $100. In year one, your timing was bad and the investment goes down by 50% and you now sit in a $50 investment. What return do you need the next year in order to get you back to that original purchase price of $100? I'm not going to give you the answer right away. Think about it. It might not be as obvious as you think. Okay, what we're going to do here is talk about the average returns over the last 20 years for the two major asset classes of stocks represented by the S&P 500 and bonds represented by the Barclays Aggregate. So per year over the last 20 years, stocks have averaged a return of 7.5%. Really solid investment return. Bonds have averaged a return of 4.8%. So I'm telling you not to own 100% stocks when they do almost 3% better than the other major asset class of bonds? Why would I say that? The answer might lie over here on the right-hand side of the screen. What do you think over the last 20-year period that we just addressed here, the average investor's returns are? Now this is represented by both those people that invest for themselves and those that pay a financial advisor to invest for them. Logically, I would bet you're thinking somewhere between 4.8 and 7.5%, right? That would be logical. This may shock you, but the average investor's return over that time frame was 2.9% per year. How does that make sense when the major asset classes return 4.8 and 7.5? The answer lies in investor emotion. We all know that you should buy low and sell high, but it's really not that easy to do when you're in that world and seeing what's going on at that given time. Let's take a look at the worst year amongst the last 20 years to give you a better idea of what that feels like. So the worst year for stocks amongst the last 20 was 2008. The S&P 500 in 2008 was down 37%. Let's also think about what was going on in 2008. The housing market was starting to crumble and it was spilling over into the banking system. And we had major banks around the United States start to fail. Unemployment was skyrocketing. Some of us lost our jobs, but all of us knew someone that lost their job. So while all this is going on in your world, which is very, very scary, if you only own stocks, that's a scary environment too because you're down 37%. And what does selling do? Although you're down 37%, it at least gives you certainty that it's not going to go down more than that. And what did investors do in record amounts in 2008? Sell out of the stock market. That's the opposite of buying low and selling high. It's hard to do. Conversely, let's think about the worst year for bonds amongst the last 20 years. It was 2013. Now, if the average return for stocks is up 7.5% and their worst year is down 37%, with the average return of bonds being 4.8%, what's logic tell you? Bonds were down in 2013 20%, 21, 22, somewhere in that ballpark. This may surprise you as well. Bonds were down in 2013 just 2%. What does this go to show us? That although stocks over the long run generally do outperform bonds, they do it with a lot higher level of volatility. And the downside and scariness of stocks can be significantly more than that downside of bonds. Let's also just look quickly here at what the other asset class did during these really bad years. So when stocks did so bad in 2008, bonds had an above average year. They were up 5%. Bonds, with their worst year in 2013, stocks had a breakout year significantly above their average of up 32%. Interesting. They don't always move in the same direction at the same time. Now let me take you back over here to the original tricky question that I gave you. If that investment goes from $100 to $50, what return do you need? So you're down 50%. Clearly you have to get back 50% to get you back to that initial investment. Wrong. A 50% return only gets you back to $75. You need, shockingly, a 100% return off of a $50 bottom to get you back to that initial $100 investment. I'm not saying it's likely to lose 50% in stocks or in bonds, but I can tell you that the downside can be more meaningful in stocks versus that of bonds, if history is any indicator. So our thought process is, let's start to think about limiting the downside and how we go about doing that, so we don't need that massive return just to get us back to where we started. So let's look at how we might do that at Life Goal Investments. And to do that, we're going to discuss the 4 different asset classes very, very quickly here. Stocks, when do they do well? They do well in a strong economic environment. Bonds, on the other side of the coin, generally do well in a weaker economic environment relative to stocks, like that 2008 scenario we drew out. Now commodities, we haven't discussed them yet. What's a commodity? So commodity are things like oil, gold, soybeans, corn, etc. Real assets. Commodities generally do well in an inflationary economy, when the prices of goods that we buy are going up. It's worth mentioning here that bonds have a strong tendency to struggle in an inflationary economy. And sometimes stocks do well, and sometimes they do poorly in that environment. So this is another way we can diversify. Lastly, alternatives. What are alternatives? It's a very broad asset class, but we can look at things like infrastructure, a toll road. Those that use the toll road pay the toll. Or real estate. A commercial building in downtown may have lots of tenants that pay the owner a rental stream. That's an alternative investment. And the interesting thing is that we put this as a differentiated return, because it doesn't necessarily do well in a strong or weak economy and inflationary environment. It's really different than the other 3, and also acts as a very nice diversifying agent. So here at Life Goal Investments, we don't try to time the market and get stocks right. If we were good at that, potentially we could see a better return over the long term. But really what we try to do is diversify amongst these 4 asset classes to get you a smoother return pattern and take the emotion out of the game. Here's an old adage from the industry: Stock Market Timing Hall of Fame. How many members do you think are in the Stock Market Timing Hall of Fame? 0. Nobody has proven over time to consistently be good at timing the stock market. If you're the first person to be a member of the Stock Market Timing Hall of Fame, go ahead and buy 100% stocks. That said, if you're like the rest of us common folk, let's diversify and create an intelligent basket of assets to smooth out the ride over time and win the long run. Thank you very much.